bank capital, cryptocurrencies, and what these mean for the competitiveness of the financial sector, the new, the old, the conventional, and the cutting edge. I'm Scott Martin from Deloitte Centre for Regulatory Strategy, and you're listening to Regulated Radio. If you thought that 10 years on from the global financial crisis, we were finished regulating the financial sector, then my guest joining me here today will surely change your mind. I've got Hardcastle and Suchitra Nair with me here to talk about some of the most important developments we're seeing in European financial policy and what they will ultimately mean for the sector. I'll talk to Rod about just how much of an impact we think the Basel III agreement will have on European banks, and then, pivoting to the very latest in financial innovation, Suchitra will tell us what keeps European policymakers up at night when they think about the risks from cryptocurrencies, what they have planned, and what we think will happen next. All this in the next 20 minutes or less. It's going to be fast, it's going to be fresh, and we're glad you're here. This is Regulated Radio. It was a cold December day in Frankfurt last year when the world's most powerful central bankers and financial supervisors descended to finally strike a long-delayed agreement central to the project of repairing the post-crisis banking sector. The agreement, as most of you will know, was called the Finalization of Basel III. It's also referred to by some as Basel IV, but who's counting? The agreement, however, was meant to address perceived flaws in the way that banks calculate the risks they are taking, and by extension, the amount of capital they need to hold against those risks. Now, the resulting framework, although still years away from implementation, has been criticized by some as having the potential to substantially increase the amount of capital that banks, and particularly European banks, need to hold, and as a result, potentially constrain their ability to grow, lend, and compete going forward. So as mentioned, I'm delighted to have Hardcastle, my colleague at Deloitte Centre for Regulatory Strategy, here with me today to talk about this. Hi Rod, welcome to the show.
Hi Scott, thanks for having me on.
So capital requirements are obviously a very important issue for the banking sector, maybe the most significant regulatory demand they've faced in the last 10 years since the financial crisis. What's been happening recently in the world of Basel?
Well, Scott, it's not so much what's been going on in Basel as what's been going on in the European Union.
You're right. A lot of observers have noted that we still need to see legal implementation of the Basel Accords in EU law for them to have any effect on European banks. Are you seeing signs that Europe won't move forward with adoption?
Not quite yet, but watch this space. You remember the European Commission asked the European Banking Authority for their thoughts on how Basel III should be implemented in the EU.
Right, that was their call for advice document last spring, wasn't it?
That's right. Well, since then, the EBA has been busy.
Really? How so?
Well, they've done their own high-level impact analysis, and more on that in a moment, and they've issued a big data request to a number of banks of varying sizes across the EU in order to undertake a more detailed impact assessment which will guide their thinking and the advice they eventually give to the Commission. That advice is due to be delivered to the Commission by the middle of 2019.
Okay, so it seems that the EBA's assessment and its resulting advice will be very influential in the process of how Europe adopts Basel III. But what do you think their advice will actually be?
That old saying about forecasts being difficult, especially when they're about the future, comes to mind.
We don't trade in those excuses at Regulated Radio. Give us your best guess.
All right. Well, in order to answer that, we need to have a look at the EBA's impact analysis of Basel III for EU banks. Now, the EU and the Basel Committee published papers at around about the same time. The Basel Committee obviously looking at the global impact, and there's some pretty clear comparisons that we can draw. We need to remember that the EBA's full report is still 8 months away, but the initial analysis shows a pretty bad picture. The EU banks face a significant increase in required capital under Basel III, nearly 17% for all of the banks across the entire survey, and nearly 25% increase in capital for European banks that qualify as globally systemically important. And that's backed up by the Basel Committee's report, which shows that EU GSIPs are significantly more affected by the changes in Basel III than American or Asia-Pac banks.
So a lot of observers have been predicting for years now that these rules would hit European banks, as you say, much harder than others. This looks like fairly substantial and even official evidence that this will actually be the case.
Absolutely, Scott. That's exactly what the numbers are showing us.
But that's not exactly in line with the no increase in overall capital story that the Basel Committee has been telling us for years, is it?
Not by a long shot, but we need to remember that the no increase in capital commitment was based on an aggregate increase for all global banks. And it's for large banks, so it's not for European banks in particular. And sure enough, if you look at the aggregate position from the Basel Committee's report, it shows that there's a much smaller capital increase globally of around about 3.5%.
So will European banks just have to take the hit and deal with much higher capital than their peers?
Given that American and Asia banks aren't affected anywhere near as much, it's hard to see European banks, or indeed the European Parliament, being happy about implementing a set of rules that affects European banks so adversely relative to their international competitors.
So what do you think this will mean then? Is there scope for the rules that are put in place in Europe to actually change?
I think it's almost inevitable that the EBA's response to the call for advice will make some recommendations on areas where the EU implementation of Basel III could be amended, primarily to reduce the capital impact. While we won't know for sure until we see the document in the middle of next year, there are a few possible areas where the EBA could propose some changes. My own view, and I need to stress that it's my own personal view, is that those changes are more likely to be targeted at making the regime less onerous for smaller banks and to support lending to small and medium enterprises rather than specifically just to ease the impact on larger banks. Although the big banks will clearly be lobbying hard for changes that will give them a level playing field.
I'm sure they will, but on those changes, can you give us some specific for instances?
Well, I guess in terms of particular changes that might be proposed, I wouldn't be at all surprised to see the retention of one of the existing operational risk approaches, particularly for smaller non-systemic banks. I mean, the new standardized measurement approach is much, much more data and calculation intensive than existing approaches, so that would be one way of easing the implementation burden.
All right, so mortgages are a really important part of European banking. Can we expect anything to be done to ease the impact on those?
Yeah, again, I expect some proposals around the mortgage portfolios, as that's an area where European banks have a very different approach in terms of keeping them on the balance sheet to some of their international competitors, particularly some of the American banks. I mean, as to what that might be, we might see some sort of exclusion of mortgage portfolios from the floor calculation, or an easing of the rules around using the at-origination valuation for the calculation of risk weights.
All right. Well, I don't think any discussion of the impact of Basel III can be complete without asking you about this new mechanism that the Basel Committee is calling the standardized output floor. This essentially limits the capital benefit that banks can receive from developing sophisticated internal models versus using the simpler risk calculation approaches set out in the standards. Have I got that right?
Yeah. The standardized floor was a major sticking point in negotiations at the Basel Committee level. Given that the impact of Basel is material for European banks, the Commission and/or the European Parliament could quite reasonably take the view that they're not obliged to implement rules that don't deliver the no material increase in capital commitment that was made at the global level, and which has since been repeated several times by leading European policymakers over the last few years. The floor might be set at a different level, or there might be exemptions for some portfolios, as I mentioned previously about mortgages, or we might have a longer transition period. The only thing I'm pretty confident about is there'll be a lot of noise about the floor before the European rules are finalised.
And Rod, when you talk about these rules being finalised, you mentioned that the EBA is of course going to play an outsized role in assessing how these rules should be adopted. But what's the legal path to actually turning these standards into laws that you can implement?
That's a good question, and the answer is that it's going to be a very complicated procedure, as always. As we've been saying, the EBA needs to send a set of recommendations to the European Commission, the call for advice, but then it's up to the Commission to review those proposals and make up its own mind on what parts of Basel III it wants to adopt and how. Once it's done that, and we expect that to come in early to mid-2020, the Commission will publish a legislative proposal with the catchy title CRD6, CRR3, and then the European Council and the European Parliament get their say on the law through political negotiations. Once all those parties are agreed, maybe after something like 2 years of talks, the legislation will be finalised and banks across Europe can finally see exactly what it is they're going to have to implement.
Well, that sounds like a process that's going to create a lot of uncertainty in the banking sector for a much longer period of time than they might currently expect.
Absolutely. It's a process that's going to make it very hard for the EU to stick to the Basel III implementation deadline of January 2022. And as we've said, very easy for it to diverge from a faithful implementation of the standards.
Wasn't it Otto von Bismarck that said that laws were like sausages? It's just best not to see how they're made.
Maybe, but in this case there's just a little bit too much sausage making going on to ignore.
I think you might be right, Rod. But Rod, thanks a lot for coming on Regulated Radio to talk to us about this. We'll have to have you back as we find out more.
Always a pleasure.
Moving right along now, some financial sector issues like bank capital have been at the top of the regulatory agenda for a long time. Others are just emerging now, driven by the development of new technologies and platforms that allow people to interact, exchange, and create new financial instruments in a way that just wasn't possible a decade ago. One of these new additions to the financial landscape has been the rising popularity of trading and holding cryptocurrencies among firms, governments, and even the general public. Now, a few years ago, this was primarily a story about Bitcoin and how it stood almost alone in its uniqueness as a currency, not tied to any government or central bank, but instead tied to a set of rules, a complex mathematical code, and underpinned by an exciting new technology called blockchain. But today, with some admittedly volatile fits and starts, new cryptocurrencies are proliferating all over the world. Initial coin offerings are becoming more and more frequent, and the accessibility of the crypto market is making big strides as well. Now, you've probably seen evidence of this yourself, not only when you read the news about cryptos, but also when you're commuting to work, taking the train, or watching a football match. Advertisements for platforms that allow virtually anyone to invest in cryptocurrencies are popping up everywhere, letting more and more people try their hand and making money in this new market. Regulators, I think understandably, have taken note and pointed out that they might have a concern or two with the kinds of risks that these financial instruments pose to financial markets and indeed to the general public. So to discuss this, Suchitra Nair, our FinTech Director here at the Centre for Regulatory Strategy, is joining us to tell us more. Suchitra, welcome to the show.
Thanks, Scott. It's great to be here.
So, Suchitra, I'll be totally honest with you. There's been a lot of talk about crypto assets recently, and I've been reading about cryptocurrencies for years, but I still struggle to get my head around what all this terminology today is actually referring to. Can you give our listeners a back-to-basics refresher on what we're actually talking about here?
Well, I'll try. Well, Scott, crypto assets, as you know, is a generic term. Put it very simply, it refers to a cryptographically secured digital representation of value or contractual rights. These can be transferred or stored or traded electronically. And when crypto assets are issued through an initial coin offering or an ICO process, then they're typically referred to as tokens.
I see. So there are actually quite a few different kinds of crypto assets that regulators are looking at.
Exactly. And that's why it's this generic term, crypto assets, that regulators have used to refer to all the users of cryptocurrencies, either as financial products, and whatever poses a risk to their objectives of consumer protection or market integrity, and of course financial stability.
Okay, that makes enough sense, but changing tack a little bit and thinking about why this has to be a concern for us. If crypto assets are just a digital representation of value, and perhaps a more modern version of traditional financial assets, why are regulators so worried about crypto in particular?
Well, the regulators have three main concerns when it comes to crypto assets, which is currently, of course, unregulated. And the top three really are money laundering and counter-terrorist financing, financial stability, as I said before, and consumer protection. Now let's just take money laundering and counter-terrorist financing. One of the key features of a permissionless distributed ledger solution is anonymity. So any DLT token or DLT-based cryptocurrency offers anonymity. That is, it's technically near impossible to identify the owners of cryptocurrencies on a permissionless DLT. This, of course, then raises the prospect in the minds of some people that they could be used to facilitate either tax evasion and or any other criminal or illegal activity.
I suppose that's why Bitcoin and other cryptocurrencies have been so popular as a method of payment for cyber criminals using ransomware techniques. Now, you're essentially saying that cryptos are as untraceable as cash, but without the physical limitations of cash.
Exactly. And that, of course, opens up a new front in the fight against money laundering. But of course, not every holder of Bitcoin or cryptocurrency is a criminal, but there are a fair share of bad actors.
That makes sense. But what else are regulators concerned about today?
The second concern is, of course, around financial stability. Trading volumes in cryptocurrency exchanges are rising, and more consumers, having seen those adverts at football matches, are using these exchanges. The financial stability risk is growing, though it's not yet systemic, given the volumes are still significantly lower than fiat currency. However, the volume of derivative products, they are rising, of course, and more regulated firms are playing in this unregulated space. And then you see this tick up in the financial stability risk rising exponentially. And I think one of the incidents that happened a few years ago, the famous Gox Raid, highlighted just what could possibly go wrong. So Mt. Gox was a Tokyo-based cryptocurrency exchange that operated between 2010 and 2014, and it was responsible for more than 70% of Bitcoin transactions at its peak. And in early February 2014, the exchange suspended withdrawals after claiming to have discovered suspicious activity in its digital wallets. The news of the suspension immediately resulted in the price of Bitcoin falling by 20%. And then the company discovered that it had lost more than 850,000 Bitcoins, which at that time represented over 6% of all Bitcoins in circulation. It managed to recover some stolen Bitcoins, but the majority just disappeared into ether, as it were. And it had to file for bankruptcy. So clearly a lot of people lost value and money in this process, and they couldn't get compensation from anywhere.
All right, that sounds like a really interesting case, but thinking a bit more broadly about the potential impact of cryptocurrencies on financial markets, am I right to imagine that our ability to understand the channels through which instability could transfer from crypto assets to the broader financial market, those are still quite primitive?
Yes, it is. And regulators recognize that the technology and the types of crypto assets that are being developed are constantly evolving. So you can't really fully understand the risks it may bring in future. But that doesn't mean that regulators aren't putting a lot of effort into monitoring crypto asset activity and putting out those risks in the form of communication to the markets and to consumers.
Indeed. And what's the key concern of regulators when they think about crypto assets and consumer protection?
Well, consumer protection in relation to crypto assets is a significant regulatory concern, a lot more than financial stability at this point in time. But as you said earlier, crypto asset adverts are very common. However, not all investors fully understand the risks of either investing in them or using them as a means of exchange. So we have seen that some consumers have been victims of fraud or have lost significant amounts of money while playing with crypto assets. And of course, when they do lose money in crypto, many have been unable to get compensation for those losses, even if they were improperly sold the product.
Why is that?
Well, simply because these products, for the most part, aren't regulated and they don't offer compensation, like, for example, your bank account, where if the bank goes down, the deposit guarantee scheme kicks in and you get some form of compensation.
I see. So there's obviously a lot for regulators to dig into here if they choose to do so. How have you been seeing those regulators respond to these developments so far?
Yes, and regulators have exercised their choice to respond to the crypto asset market. I think the most interesting development for me in the UK was the recent UK Crypto Asset Taskforce report, which was a joint publication from the UK Treasury, the FCA and the Bank of England. And they've said that they're going to consult on a piece of regulation to prohibit sales of derivatives that reference crypto assets. So we will definitely get more regulatory activity in this retail investor and crypto asset space.
So thinking a bit about our friends in Brussels for the moment, have EU regulators done anything in this space?
Well, both UK and EU regulators have issued warnings on the risks associated with investments in cryptocurrencies and their derivative products. At the EU level, the fifth iteration of the Anti-Money Laundering Directive, or AML5, which should be transposed by member states by end of 2019, it captures certain cryptocurrency activities. For example, exchanges which convert fiat currency, your euros or your pounds, to crypto assets, and custodian wallet providers. These parties will need to comply with stricter AML requirements. And the UK, in its recent Crypto Assets Task Force report, is expecting to go a step beyond that and build on that AML5 regulation. So they are widening the scope of it, so exchanges facilitating conversion between different types of crypto assets will be caught. Non-custodians who perform similar functions to custodians will be caught. The underlying objective really of that widening of the perimeter is to prevent layering of financial crime or fraud, which makes it difficult to detect. All this, of course, will be subject to consultation in 2019 and beyond before it becomes a regulation. Okay,
but you mentioned the UK and you mentioned the UK Crypto Assets Task Force report. Do you have any more detail on the approach that we can expect to see UK regulators take?
Well, the gist of the technical guidance is if it walks like a duck and talks or quacks like a duck, then treat it like a duck. Well, in essence, if any product looks or achieves the same outcomes as an existing regulatory product, it may be caught by the regulatory perimeter. So that's been the UK position. More formally, we now have a UK crypto asset framework, which categorizes crypto assets into three types: exchange tokens, security tokens, and utility tokens. So security tokens are likely to be caught by existing regulation if, for example, it's held for investment purposes.
So Suchitra, last question. Do you think we've reached a sort of tipping point where regulatory activity is going to accelerate now across a number of different jurisdictions?
Accelerate is probably a strong word, but we're definitely seeing regulators taking action beyond just issuing risks and warnings. It's reached a point where enough retail consumers are taking a gamble on crypto assets and losing money. It's reached a point where some jurisdictions are running ahead and putting out regulation, which means that there's a place for regulatory arbitrage, which regulators obviously don't like. And in fact, there's a reasonable demand from crypto asset firms to be regulated. So we can see that jurisdictions who regulated ICOs first, Switzerland being a case in point, attracted a lot of crypto firms. So they do want to be regulated, which is quite unique in the financial services sector. However, I mean, practically, it's really hard to implement detailed regulatory requirements in a fast developing area. In essence, that's why we now have a framework for looking at crypto assets, with a caveat that, of course, it may evolve.
So an increase in regulatory scrutiny isn't always a burdensome thing, then?
Well, it may be for some. Let's not forget that it is burdensome to comply with regulation, but it comes with advantages for innovative players. Many players welcome it because it gives them credibility in the market. So yes, there is definitely a demand for it.
Right, I think that's a very fair point. Suchitra, thank you so much for coming on to Regulated Radio to talk to us about this.
Thanks for having me.
Well, that's our show. Bank capital and cryptocurrencies, just two of the big issues in the massive shorefront of challenges that regulators and the financial sector are facing today. But that's why we're here. That's why we do Regulated Radio, giving you a short burst of food for thought on the top issues from our sharpest thinkers. Now remember, if you like the show, hit the subscribe button to ensure you receive notifications about new episodes. And if you're already subscribed, you can give us a review on those platforms or recommend Regulated Radio to a friend or colleague. It makes the perfect early Christmas gift. But that's all for now. Thanks so much for joining us, and you'll hear from us again soon.